If you went to sleep last night thinking oil was about to skyrocket, defense stocks were going higher, and the market was heading for another panic sell-off, you may have woken up to a completely different story. Because at the last second, literally with bombers already in the air, the United States and Iran agreed to a temporary 2-week ceasefire, and that changes everything. The biggest reason is not politics. It is not the headlines. It is not even the war itself. It is one tiny stretch of water that most investors have never thought about until now. The Strait of Hormuz. Nearly 20% of the world's oil flows through that narrow passage. And over the last few weeks, investors were pricing in the possibility that Iran could close it, slow it down, or make it dangerous enough that ships would stop using it. If that happened, oil could have gone to $120, $140, maybe even higher. But now Iran is saying the Strait of Hormuz will reopen under the ceasefire agreement. That means one thing: the fear trade may be ending. And if the fear trade ends, a whole new set of stocks suddenly become more interesting. Before we get into the winners and losers, here is what actually happened. According to reports, the US was preparing for another major wave of attacks on Iran. Bombers were already flying, but at the last moment, Iran agreed to open the Strait of Hormuz and pause military activity for 2 weeks while negotiations continue. Israel is also reportedly joining the temporary ceasefire, although there are still questions about Lebanon and whether all military groups in the region will follow the deal. So this is not permanent. This is not peace. This is simply a pause. But in the stock market, even a pause can move billions of dollars, because markets do not wait for certainty. They move on expectations. And the expectation right now is that oil shortages may not happen after all. That is why the very first group of stocks investors need to watch are oil producers. For the last month, oil stocks have been rallying because investors believed higher oil prices would boost profits. Companies like Exxon Mobil, Chevron, Occidental Petroleum, and ConocoPhillips all benefited from that story. But if the Strait of Hormuz stays open and more oil starts flowing again, crude prices could fall quickly. That does not mean these companies are bad businesses. In fact, many of them are still printing money. But it does mean expectations may have gotten too high. If oil drops from $95 back down to $75 or even $70, some of these oil stocks could pull back hard. The most vulnerable are probably the smaller, more speculative energy companies that only work when oil prices stay elevated. That includes high-debt shale producers and smaller exploration companies. Those are the ones that can rise fast during a crisis and fall even faster when the crisis starts fading. Now, here is where things get interesting, because if oil prices fall, some other industries could suddenly become major winners. The first winner is airlines. Airlines hate high oil prices because fuel is one of their biggest expenses. When oil drops, airline profits can improve almost overnight. That means companies like Delta, United, American Airlines, and Southwest could benefit if this ceasefire holds, not only because fuel gets cheaper, but because investors may start believing travel demand will stay strong and recession fears will ease. The second winner is transportation and shipping. If the Strait of Hormuz opens again and oil tankers begin moving more freely, global shipping becomes easier, cheaper, and more predictable. That helps companies involved in freight, logistics, and shipping. It can also help retailers because lower transportation costs eventually mean lower costs for everything from electronics to groceries. The third winner might surprise you: technology stocks. One of the biggest reasons tech stocks struggled whenever Middle East tensions increased was because investors feared higher oil prices would keep inflation high. And if inflation stays high, the Federal Reserve is less likely to cut interest rates. But if oil drops, inflation pressure may also start to ease. And if inflation eases, suddenly investors start getting excited about rate cuts again. That is very bullish for high-growth tech companies. So if this ceasefire holds, you could see companies like Nvidia, Tesla, Amazon, and other major growth stocks start moving higher, especially after what has already been a volatile year. Now let's talk about the one sector that may have already peaked: defense stocks. Whenever geopolitical tensions rise, defense stocks usually jump, and that is exactly what happened. Companies like Lockheed Martin, Northrop Grumman, RTX, and General Dynamics moved higher as investors expected more military spending and more conflict. But if the headlines shift from war to negotiations, those same stocks could cool off. Again, I am not saying defense companies are suddenly bad investments. Many of them have long-term contracts and still benefit from global instability. But if you bought them only because you thought the conflict would escalate immediately, you may want to think carefully about whether that trade still makes sense. Because one of the biggest mistakes investors make is chasing yesterday's news. By the time a headline feels obvious, the market may have already priced it in. Now there is one more thing investors are missing. This deal is only for 2 weeks. That means the next 14 days could be some of the most important days of the year for the stock market. If negotiations continue and the ceasefire becomes permanent, oil could keep falling and stocks could rally. But if talks break down and the conflict returns, then everything flips again. Oil could spike, defense stocks could surge, the market could sell off. That is why this is not the time to go all in on one side. The smart move is to stay flexible. Watch oil prices every day. Watch the Strait of Hormuz. Watch airline stocks, defense stocks, and energy stocks. Because these may become the clearest signals of where the market thinks this story is heading. Personally, I think the market is starting to believe that both sides want a deal more than they want another war. Iran needs its economy, the United States wants lower oil prices, and the rest of the world desperately wants the Strait of Hormuz open again. If that happens, we may look back at this moment as the turning point that sent oil lower, inflation lower, and stocks higher. But until we know for sure, this is still a headline-driven market, and headline-driven markets can change in minutes. So do not invest based on emotion. Do not panic buy defense stocks after they already ran up. Do not panic sell energy stocks just because one ceasefire headline appears. Instead, build a watch list. Here are the stocks I would be watching most closely over the next 2 weeks. Potential winners: Delta Airlines, United Airlines, Nvidia, Tesla, Amazon, FedEx. Potential losers: smaller oil producers, Lockheed Martin after its recent rally, high debt shale companies. Potential wildcards: Exxon, Mobil, Chevron, Occidental Petroleum. Those companies may fall if oil drops, but they could also bounce back quickly if the ceasefire fails. So they are probably the most important stocks to watch right now. And if you want, in the next video I can break down exactly which stocks I would buy, avoid, or short if the ceasefire holds for the full 2 weeks. So let me know in the comments, do you think this ceasefire is real, or do you think the market is being too optimistic? And if you enjoyed this video, hit like, subscribe, and turn on notifications, because over the next 2 weeks, this story could move the market every single day. This video was inspired by the recent ceasefire developments and negotiations involving Iran, the United States, Israel, and the Strait of Hormuz.